Okay, hello. Well, we're we're on the last chapter, chapter 12, and it's about capital investments. And so there's a number of different concepts going on. And one of the things I've decided to do is because there's a lot of numbers, rather than writing out the numbers as I have in the past, I have them kind of set up. So I'll still be using the pen and kind of highlighting things, but a lot of the problems I have kind of worked out so that a lot of the decimal places and whatnot won't get kind of lost in my handwriting. Well, let's go ahead and take a look at what we've got. So we're going to go over pretty much just learning objective number 2, payback period and accounting rate of return. Before we get going any further, let's try and place capital investment in the overall grand scheme of things that we've been studying. So if you remember this chart, we were using this chart for budgeting. And on the left side, the orange side, that was all kind of the production side. On the right side was all kind of the cash side. And I explained at that time that, well, let's see, do I have my pen up and running? I do. I explained at that time we would go over this mysterious bucket at a later date. Well, that later date is here. So on the cash side, we have a big cash expenditure, and that's what CapEx stands for, capital expenditure. So while the title of the chapter may be capital investments or the learning objective, we actually typically call this CapEx. On the financial programs, you'll hear them talking about CapEx this, CapEx that. So CapEx, capital expenditures. And expenditure, well, that's a cash item. And the main thing about capital expenditure is not that we can't fit it into the budget. We can put the numbers on the budget. Our main thing that we're concerned about really in this chapter is, can we justify the expenditure? Or maybe another way to put it, we want to buy a piece of equipment or any other type of long-term investment, and we want to know, are we going to be better off by buying this piece of equipment? So we need to do some analysis to figure out whether or not spending all this upfront money, we got to pay for the money up front, but we're going to earn back the price of the equipment or the new plant or whatever the investment project is. We're going to earn it back over multiple years. And therefore, we need to make sure going in that we have done at least some sort of analysis to figure out, was it worth it? Was it worth buying this big thing, this big new plant? We bought another company, all sorts of things. So that's why we fit it in kind of under its own chapter, because it's more than just a budgeting. It goes more towards, is it worth it? So we have a couple of different ways in which we look at, is it worth it? And it's going to be kind of in two major categories, non-discounting and discounting. Don't get too hung up on the nomenclature quite yet. The idea is that there are two categories, and we're going to kind of, in this first video, we're going to study the first category, the non-discounting, payback period and accounting rate of return. In the next video, we will go over discounting, which is net present value, primarily net present value, but we'll also touch on internal rate of return and the profitability index. Those are kind of two lesser ones. The difference between these two is that whenever we talk about, in accounting, whenever we talk about things over a year, we have to take into account what we call the time value of money. In other words, yes, I may buy this piece of equipment and it may get me some sort of return as time goes on. But was that return better than just investing the cash straight up? In other words, I could have bought this piece of equipment, it got me back 1%, or I could have invested the cash and gotten back 5%. So whenever we do this analysis, we got to make sure that it's better than some kind of threshold. So the discounting methods, these down here, I'll take into account some sort of interest rate, some sort of accounting for interest rate. Whereas the non-discounting, these do not have interest rates attached to it. They're more just straight calculations. Okay, so let's take a look at the first one here. So it's important to notice that here we are actually talking about cash flows. And with payback period, we'll talk about cash flows, and the accounting rate of return, we're more interested in the operating income. And sometimes we've got to go back and forth. Sometimes we're given one and we got to figure out the other. So just be aware that I'll try and highlight when the wrong piece of information or when a piece of information has been given that we need to translate. So here we've got a question similar to question number 2. We've got 2 machines, we got 2 products, and each of them has a special machine need, and both of them cost $1 million, 5 years life, 0 residual. And we have a decision test for payback period. The payback period has to be less than 3.5 years, and accounting rate of return must be 8%. So the payback period, which is what we're going to look at first, is we buy this piece of equipment, how much cash does it bring back? And that's why we're looking at cash flow. Does it bring back more cash in over a certain amount of period of time than what we paid out? In other words, if we pay $1 million and this thing, and it has a 5-year life, and it brings back $5 million every year, or it brings back $500,000 every year, well, at the end of the 5-year life, we will have gotten $2.5 million for spending $1 million. Well, of course, we'd all do that. So the other thing that we want to make sure is just notice that the 5-year life and the threshold, typically the threshold or the decision is less than the life. In other words, you don't want something that has a useful life of 5 years, but the payback period is 10 years. In other words, you're going to, after it's no longer useful, do you still want to be paying it off? Well, you don't. So that's the first thing to notice, is that the payback period decision is hopefully less than the actual useful life. If it isn't, if the payback period is over the useful life, well, then you're going in the wrong direction. So we've got these 2 cash flows. And if you notice that essentially the cash flow for the action toy is the same every year, and the sandbox, the cash flow is different every year. And that's because we're going to look at 2 different versions or 2 different calculations. So here, what is the payback period? Well, it's a very easy thing. It's what's the initial investment? Well, that's $1 million. And the expected annual cash flow. Now you notice here, when we're actually looking at just, because I think the question here is specifically to action toys, we're looking just at this because the cash flow is the same every year. We can just use that number and we find out that the payback period is 3.2 years. Now notice they come up here and they've got this useful life and this residual, and they're throwing extra information in. And with payback period, we have to remember payback period, as I set up here, is focused on cash flow. A residual or a useful life, that's all used in calculating depreciation. Depreciation is a non-cash expense. And so cash flow and depreciation, they don't go together. However, because accounting rate of return is focused on operating income does try and include the residuals and the depreciation. So for here, the reason why we say the question asks, does the residual change anything? We say it does not change anything, because with the payback period, the payback period is focused on cash flow. Residual has to do with depreciation. Depreciation is non-cash, therefore we don't bring it into our calculation. And then, did it pass the threshold? Well, yes. We wanted it to be less than 3.5 years. It ended up being 3.2 years. So our first, pass at whether or not investing $1 million into the special machine for the action toys is worth it, we say yes, at least according to the payback period analysis. We would do multiple analyses. We would do one maybe of a couple of different types and then compare and contrast. Well, we're going to take this same information, except what we're going to do is we're going to look at the payback period for the sandbox. So the sandbox, we notice that we have different amounts each year. Now, the truth is, if you see up here, all we did was divide, right? We divided the initial investment by the cash flow and we got this 3.2. But if I actually went back and added it up, I would say, okay, this would be the first year that we would have gotten 312,000. The next year we've gotten 675. The next year we would have gotten 900 and whatever. In other words, as I go along, I would add these up, and then I would find out 0.2 into year 4 is when I would hit the 1 million mark. And essentially that's what we're doing here. Is what we're going to do is we're going to count down, or we're going to add down until we get to it. So if I said, okay, year 1 I had 518. So this is the individual amounts, but if I looked at a cumulative amount, if I said cumulative, I would say this next year is 898, right? That would be the total cumulative amount. So what it's saying here is after 2 full years, we've gotten 898. And if I subtract that from a million, the remaining amount is 102. So somewhere in here, somewhere in year 3, I actually hit the payback period. So what it's saying is 102,000 into the 340,000 year is when I hit 1 million. And so that's what we do here. We take the 2 years and then we figure out what portion 102 is of that 340, ends up being 0.3. And so we say the payback period for the sandbox is 2.3 years. Now notice the payback period is a lot faster. And would we say yes or no? Well, not necessarily. Just notice that the sandbox is front-loaded. It has a whole lot at the beginning, but then tapers off, whereas the action toy is steady throughout. So depending upon other criteria, we may or may not approve of one over the other. So that's payback period. We look at cash flows, and essentially we're adding down until we figure out how many full years plus what partial year do we get back to the investment. How long does it take us to pay back that million that we invested in the machine? If we go on to question 4, now we're looking at ARR. We're looking at the accounting rate of return. It's all the same information. All the same information that we had in the previous two. And all we're saying here is in order to figure out, here I'll actually show you down here, ARR is figured out by taking the operating income and dividing it by the initial investment. So in other words, how much of the what percentage of the initial investment is being recovered as operating income? Well, operating income is after all costs, is after all expenses. So we're given cash flow, but we need to change cash flow into operating income. And how do we do that? Well, the easiest way, I guess the rule of thumb, this kind of small way, is the biggest non-cash expense is always depreciation. So what we do is, we take cash flow and we subtract out depreciation essentially to get to our operating income. Now this might not be completely perfectly right, but it's close enough for us to at least get an idea of the accounting rate of return. So what we do is, well, now we're going to need this 1 million, this zero residual in the 5-year life. So we take the depreciation amount, the 1 million, divided by 5, 200,000, and just like I said, we take the cash flow all the years are the same here, 312,000 minus the 200,000 of depreciation. And so the actual operating income is 112. So notice that the operating income is different from the cash flow by the amount of depreciation. Now that we have operating income, we can divide it by the initial investment and we get an ARR of 11.25. Now, is that above our 8%? Well, yes, it is above 8%. Would it change if it was 175,000? If the residual was 175,000? Well, yes, because the residual affects this depreciation number, right? So what we're going to do is we take the same cash flow, but we have to recalculate the annual depreciation. So this part is all the same. Well, it's not all the same numbers, but it's the same procedure. All we do is we calculate the initial depreciation. So if you notice, the initial depreciation basis was a million up here, was a million. But because we have a residual of 175, we actually have a basis of 825. We subtract out the residual. In other words, how much of the machine did we use? We used 825. So we take that down here. Now the 1 million becomes 825, and then the rest of it flows through the same. Divide by 5 to get the annual depreciation. We subtract that annual depreciation from the cash flow. We get a new operating income. And now the annual operating income is 147,500, and therefore our ARR is a little bit higher because we didn't use up all of that piece of equipment. So whether it's 14.75 or 11.25, both of those are above the 8%. So we would say yes to this. This would be okay in our book. Okay, so I'm going to skip over question number 5 because it's relatively similar to question 4. And then these last two I want to focus on kind of important bits of information. Or I don't want to say that. I want to say it's key things to look out. In other words, some points that there are going to be questions that kind of dance around this subject, and I kind of want to draw them out to the open. I kind of mentioned it earlier, but it's good to remember. And so this question number 6 is kind of a relatively simple question, but it's there designed to kind of highlight this fact. $900,000 to purchase this factory. This is our investment. This is our cash flow, and we're trying to figure out the payback period. So remember, payback period does deal with cash flow, so we're okay. So all we do is divide it out. It's the payback period of 3 years. It takes us 3 years to get the amount of cash back that we initially spent. So you notice the payback period is 3 years. Important to compare and contrast is it will be replaced in 8 years. If for whatever reason, let's say this was 900,000, and instead of the cash flow being 300,000, the cash flow was 100,000. Well, 900 divided by 100, that would be 9. So we would have it for 8 years, replace it, and then we would still be paying on it for another year. In other words, the payback period is it doesn't mean much in and of itself until you compare it to the life or the replacement time of the piece of equipment. In other words, it's hard to tell whether this number is good or bad until you compare it to the life of the piece of equipment, or how long that the investment project's going to go on. So always kind of be aware of that. Sometimes it's not completely clear that a question's asking that, but that is the primary purpose of the payback period, is just to see, is this new investment going to throw off enough cash to pay back the initial investment before we finish with the piece of equipment. And the next piece of kind of interesting information is focus on the fact that I kind of highlighted at the beginning. Payback period is dealing with cash flow, and ARR is dealing with operating income. And sometimes they give you one and you have to go from the other. So sometimes you got to go between these two. But let's take a question that's question 8 that I think perhaps someone may not understand why the problem is working this way. So here we're given a bunch of information. We've got plan A and plan B. We've got two different equipments and then pieces of equipment. We got operating income, and then we've got these life and residual. And you notice here, and I'm pointing it out, that this one is 0 residual and this is $100 residual. And we spent all that time on the previous question adjusting for the residual. Well, we adjusted for the residual on this previous question here on this one because we were given cash flows. Because of the cash flow and the fact we were given residual and depreciation life, we needed to figure out the operating income. That is not the case in this one. And I think that could be it could throw someone. That they give us operating income. They don't give us cash flow. So in effect, this depreciation information is not really needed. And you'll see that in the actual calculation. So here you have 153 divided by 900, a straight usage of these two numbers. And similarly here, 249 divided by 1.35. And so you get the two ARs. These residuals don't come into it. The theory or the thinking is that once you get to operating income has already incorporated any sort of special depreciation or residual, because operating income comes after depreciation on the income statement. So just be aware, because you may try and figure a way to get this 100,000 in and kind of mess up your calculation. Just be aware of what AR requires. ARR requires operating income. If you already have that, you don't need to fiddle with the depreciation or the residual. If they give you cash flow, Well, then you need to go from cash flow, subtract out depreciation to get to operating income. Okay, so this video is right at 20 minutes. And I think I went a little faster because I didn't have to write all these numbers in. I just wanted to make sure that when I publish this, that you have all the right numbers sitting there, and especially more so in the next video. So I will. The next video will probably be a little longer because we're going over a few more in detail concepts. But I'll leave that for right now. If you have any questions, please email me or catch me on Zoom.